Good morning and welcome to Financial Accounting. We are today going to be picking up with exercise 6 in chapter 3. So last class we started chapter 3, we talked about the adjusting process. We explained why we needed to do this adjusting process at the end of each accounting period, because some of our transactions span more than one period, because we don't use cash basis accounting, we use accrual accounting. And so for that reason, we need to make some changes or adjustments or corrections really to our financial statements at the end of each period to make sure that we have applied the matching principle, that we have recorded revenues when we earn them, and then matched against those revenues the appropriate expenses that helped us to generate those revenues. By doing that, we make sure that both our income statement and our balance sheet accurately, fairly represent what's happening inside our business so that decision makers who are using those financial statements have the best possible information to make those decisions about our company. So last class, again, we talked through why we do adjustments, and we started looking at how adjustments happen. So in the last exercise we did, we started with a trial balance that already had the adjustments entered. And then we went through, so how would we talked about for each one of them, why would this adjustment happen and what would it look like? Today, starting with exercise 6, we're going to be looking at some very specific adjustments and talking about how and why they would happen and what they would look like. So as I've said in other circumstances, we cannot possibly in this class talk about every single possible scenario out there for every business. And so we tended to go with the general, the stuff that happens for many or most companies. And I will also talk about, sometimes there are different ways of accomplishing the same goal. And so I will mention as we look at each of these how some companies may choose to handle this adjusting process. As I said before I started recording, if we have time at the end of class, once we finish all the exercises for chapter 3, I will talk about the exam, which will be next weekend, not this coming, not starting tomorrow, but next weekend. So I'll be talking about that if we have time. If we don't have time today, we will do that on Monday. So as we look at our calendar, we can see we have one item due today, and that is the chapter 3 exercises. So assuming we get through the 5 remaining exercises today in class, you should be submitting those exercises for grading by the end of the day today. And then I'm sure by now in chapter 3, you've gotten the flow of how things work. Next class, Monday, Valentine's Day, we will have the chapter 3 problem should be submitted for grading, and we'll be starting chapter 4. So the chapter 4 pre-quiz, don't know why there are 2 dashes in there, that's kind of weird. Chapter 4 pre-quiz will be due on Monday, should be submitted by the end of the day as well. So I need to point out, just to make sure everybody understands this, because of the fact that we have just 30 class meetings during the semester, I can't wait until we've finished everything from chapter 3 and take the exam to start chapter 4. The timing for that just would not work out. I don't want you taking the exam until after you've completed the problem. But because we have a chapter to cover each week, next week, we're going to be covering chapter 4. Chapter 4 is not on the exam. So we will have completed chapter 4 possibly, probably, before you take the exam that covers chapters 1, 2, and 3. The reason I am mentioning that is because you do have the option, if you choose, you do have the option to take that exam anytime after you finish the chapter 3 problem. So if you think for your brain it would be more straightforward, more cleaner to finish chapter 3, take the exam, then start chapter 4, you have my permission to do the chapter 3 problem, submit it, and take the exam this weekend like starting tomorrow. So that's one reason, if we have time, I do want to talk about the exam today. If we don't get to the talking about the exam today, if we do run out of time, I will point out to you in the reference materials folder. You just go down to the chapter 3 folder here. You can see that there is a video here, and I will leave this posted if we don't get to the exam, talking about the exam today. I will leave this posted, and you may want to watch this video before you take the exam if you choose to take it this weekend. Again, totally up to you. It is not due until next week. But I have in the past had people express concerns that we start a chapter, but it's not on the exam. I get confused. And I understand that there's just not anything I can do about the timing because of the nature of our class. So please feel free, if it works better for you, to finish up chapter 3, take the exam. We will be starting chapter 4 on Monday. All right. Questions about any of that or anything that we talked about so far in chapters 1, 2, or 3? Those are the 3 chapters that will be on this first exam. All righty. If there aren't any questions then, let's go to our exercises. And we finished exercises 1 through 5 together in class on Monday. And so today we will pick up with exercise 6 and just work our way through to the end. So if you look at exercise 6, you can see that this exercise is about salaries. Exercise 7 is about supplies. Exercise 8 about prepaid insurance. Exercise 9 about depreciation. And then exercise 10 is related to that depreciation in exercise 9. So none of these is a long exercise. They're all fairly short and straightforward. But I want to talk a little bit about each one because, as I said, these are the types of adjustments that most or maybe even all companies need to do on a regular basis. And so it's important to me that you understand why we do it, not just how do we make the entry, but why does it work like this? Where do the numbers come from? Putting the numbers in, doing the journal entries like we're going to do here, that's the bookkeeping part of accounting. And that's absolutely critical. If that part doesn't get done right, then the result, the financial statements, the reports that we produce are not going to be very helpful. So I don't mean to diminish the importance of bookkeeping. It's absolutely critical. But accounting is bigger than that. Accounting is, what do we do with these numbers? And so part of that, and the reason this is called principles of accounting as opposed to bookkeeping, or a class that JCC offers called Accounting Fundamentals. The difference between this class and that class is this class also focuses on the why do we do it. And I think that's really helpful in the workplace if you encounter something that maybe you've never seen that before. If you understand the why part of it, the principles, it will be easier to figure out, well, how do we handle this even when you haven't seen it before. So let's talk about exercise 6. Paradise Realty Company pays weekly salaries of $25,500 on Friday for a 5-day work week ending on that day. So in case you are not aware, the difference between wages and salary, wages generally means that you are paid by the hour, right? So you have an hourly rate, whatever it is, $15 an hour, whatever, and however many hours you work, multiply that by the $15 an hour. And if you're eligible for overtime, maybe you're getting time and a half for any hours over 40 or whatever. Salaries means that you get paid the same every pay period, regardless of how many or how few hours you work. So you work a 60-hour week one week, and the next week you have 3 days off for vacation or holiday, your pay is the same. So that's the difference between salaries and wages. There are other minor, other legal differences, but for our purposes, that's what we need to know. Our workers are getting paid on Friday for the work that they did for us on that week, Monday through Friday. Altogether, our workers are getting paid $25,500 on Friday. So if I were to just set up kind of a schedule here, Monday, Tuesday, Wednesday, Thursday, Friday, and our work is, we don't work over the weekends. It's a 5-day work week. This isn't maybe an office kind of situation. And so on Friday, we're going to cut checks, do direct deposits, whatever, for a total of $25,500. Probably, as you know, because most of you have probably had a job before, you don't actually get a check for the full amount. There's going to be some withholdings from that. We will address that part of this payroll issue in Chapter 10 on current liabilities. For now, we're just going to pretend there is no such thing as taxes. Wouldn't that be the nice world? And so on Friday, we're going to pay the full $25,500. In reality, though, it doesn't actually matter for our purposes here. Our employees are earning $25,500. We are going to report as expense $25,500, even though we don't actually give them that much cash, because some of that cash we withhold and pay toward their taxes to the federal government, or the state or local government, Social Security, and so on. So as we discussed on Monday, our employees are going to earn $25,500 on Friday, but Part A tells us that assume that the accounting period, usually what we mean by that is the month, assume that the accounting period ends on Monday. And I gave you the specific example on Monday in class. I asked the question, when do you get paid? And people said things like every Wednesday, Thursday, Friday. I said I get paid every other Friday. And nobody said, yes, but sometimes I get paid early because it's the end of the month. There wasn't a single person in here who said that's the case. And that's going to be the case for Paradise Realty Company as well. Even though the month ends on Monday, we're still not going to get paid on Friday. But from an accounting perspective, when we prepare our financial statements for the month that ends on Monday, we need to include the cost of our workers for Monday in that month's reports, right? We have to match the cost for that month against the revenues for that month. So we're not going to pay it till Friday, but we still need to get the expense into our records. So how do we go about doing that? Well, we're told that the weekly salaries are $25,500. So how much would that be per day? Excuse me, grab my calculator. Not that I really need a calculator for this number, but probably will for an upcoming calculation. Does everyone agree with that? If we're paying our employees $25,500 for a 5-day work week, that is equivalent to $5,100 per day. Yes? Okay. So on Monday, and I need to be careful with this, we may not make that entry on Monday. We might actually make the entry on Tuesday or Wednesday and just date it Monday. That's okay. Okay, so you don't have to date things the day you're actually entering them. Excuse me. Dated Monday, though, we need an entry to record 1 day's worth of cost for our employees. And that would be salaries expense. We need to, on Monday or with Monday's date, we need to record $5,100 worth of salaries expense. But we all agreed on Monday of this week in class that we're not actually going to pay them on Monday for Monday. So what do you think the other side of this transaction would be? And remember what we said on Monday about adjusting entries. We had said they're going to look just like a regular journal entry, date, at least 2 accounts, 1 debited, 1 credited, equal dollar amounts. So we know we're going to need a credit for 5,100, right? But the other rules we had for adjusting entries from Monday were it's never going to affect cash. So we know the credit's not going to be cash. We know we're not paying our workers early just because the month ended. We need 1 income statement and 1 balance sheet account. So salaries expense is the income statement account. So we know we need a balance sheet account. Of the options we see here, which one do you think it would be? Salaries payable. Salaries payable. And if you'd said accounts payable, the software would have marked you wrong, but I would have been okay with that because the concept is it's a payable, it's a liability. We owe our workers for that 1 day of work because they worked for us on Monday. Even if the workers don't show up on Tuesday, we still owe them for Monday's work, right? Even if they quit and say, I'm not coming back, even if Monday was their last day before retirement or before they leave to take a different job or whatever, we still owe them for the work they did on Monday. And so for our financial records for that accounting period, for that month, we need to show on our income statement, we have the expense, and on our balance sheet, we owe our employees. And so I would have been okay with accounts payable because you had the right idea that it's a payable, we owe someone, we have to pay them later. It's just not the account that we use for when we owe our employees for their work performed. Accounts payable is typically used just for our suppliers when they sell us stuff on credit and we just have to pay the bill later. Does that make sense? Okay, so as is frequently the case, what we do in class is kind of a simplified version, but you get the idea of how it works. Now imagine that this company has 1,000 or 10,000 or 100,000 employees, and some of them are salaried and some of them are wage earners. And so in order to do this entry, we would have, and be precise about it, we would need to have an estimate or an actual number for each employee. How many hours did they work on Monday? What's their pay rate? Did they have any overtime, or do we expect them to have overtime assigned to Monday? They worked a 10-hour day, maybe they work 10 hours every day. So this calculation can become quite complicated. And it can be an estimate, okay, especially if this is a monthly report or even those quarterly reports. We're probably estimating that number more so than making an exact, precise number. For our year-end financial statements, it's much more important that it's an exact, precise number. But we have more time at the end of the year to accumulate all of that information, making our entries into the next year, just dating them for the end of the year, and preparing our records for before our auditors come. So it is much more important at the end of the year that we have an exact number, in part because we need to make sure that those audited financial statements are more accurate, more supportable with documentation. And so we still have some estimates in our year-end reports, but we try to limit the use of estimates at that point. Okay, so again, typical normal calculation that most companies will need to do. The only companies that I would suggest could avoid this would be, again, thinking back to what we discussed on Monday, sometimes companies that pay salaries will pay those salaries like the 15th of the month and the last day of the month. One of the jobs that I had in a previous life, that's how we got paid, twice a month, 15th and the last day of the month. And so if we paid everyone on the last day of the accounting period, we wouldn't have to do an accrual because we'd know we had already compensated everybody. But in general, I think there's less and less of that today. And so most companies, as I said, would have to do this type of adjustment. What I would like to do now for Part B is ask you to do that on your own. I'm going to do mine up on the screen, and this should be fairly quick, so I'm not going to pause the recording. But go ahead and try Part B on your own. I'm going to put mine on the screen. Check yourself by using the check my work button, or look at what I have on the screen to check yourself. Okay, so the entry looks basically the same, but rather than having just one day at $5,100, we have 4 days at $5,100 because the period we're now assuming ended on Thursday, same information. So the only thing that would carry over to the next month would be Friday's pay. I want to talk just another minute about this situation, but does anyone have any questions about how to do these entries? Okay. So what I want to talk about is what happens next for this company. So how is it that we, on Friday, can still pay them the full amount that we owe them without creating any kind of issue within our accounting records? And I think probably the easiest way to do that is just to put a couple T accounts, couple T accounts here on the screen. So we haven't talked about yet the closing process, although I have multiple times this semester talked about within that chart of accounts, which accounts are permanent and which ones are temporary. And so at this point, you should get that the balance sheet accounts, assets, liabilities, and the permanent stockholders' equity accounts, which at this point include for us common stock and retained earnings. Those are the permanent accounts on the balance sheet. Those are the accounts that whatever we have in them at the end of one period, as the ending balance becomes the beginning balance for the next period. All of the other accounts, so all the accounts that don't appear on the balance sheet, so that would be dividends, revenues, and expenses, those accounts we refer to as temporary or nominal accounts, and those accounts do not carry their balance forward. What that means is, at the end of each accounting period, we need to zero them out. And the way we zero them out is by, I'm simplifying it just a little. The way we zero them out is by taking all the value that's in there and moving it to retained earnings. Which kind of makes sense if you think about it. Revenues and expenses make up our net income. And we saw on that statement of retained earnings or statement of stockholders' equity that net income gets added to retained earnings. So it makes sense that our revenues and expenses, which make up net income, we would zero those out and move whatever is left. That's our net income or our net loss. We move that to retained earnings. The other piece is the dividends, and we've mentioned that a couple of times already. Dividends come from retained earnings. So it's earnings of the company that we didn't retain or we didn't keep. We paid it out to our stockholders. So for now, you don't need to be worried about exactly how that works, exactly what the accounting would look like. But I think you can probably think it through at this point anyway, how that would work. But for the purpose, for the sake of this exercise, what I'm trying to show you, what's important is that the salaries expense is a temporary account. And so it's not going to carry its balance forward. And the salaries payable is a permanent account. So whatever's in there is going to carry forward. And I'll use part B to show you how this works. So in part B, when the pay period ended on Friday, but the month ended on Thursday, this was the entry that we created. A debit of $20,400 to salaries expense, and a credit for that same amount to salaries payable. We know this is an adjusting entry, so it can't affect cash. At the end of the period, this salaries expense contributes to our net income, right? The more expense we have, the less our income would be. That salaries expense gets rolled into our net income. We zero it out of this account. We take it away. It moves to retained earnings. The salaries payable part, though, does not go anywhere because it is a permanent account. And so whatever we owed to our employees at the end of the month, we still owe them the beginning of the next month. And I certainly hope that's the case, right? Otherwise, what could happen here? If we zeroed out that payable on Friday, when payday comes, they'd say, yeah, but we're not paying you from Monday through Thursday because that was last month. We don't owe that anymore. It needs to be that that payable, that liability carries over so that on Friday, payday, we pay the whole amount. And so what does that look like? On Friday, we're going to pay the full $25,500. So we're going to credit cash. We would debit $20,400 to salaries payable because we will not owe that anymore. We need to zero out that liability because now we have paid it. And the rest, the other $5,100, gets recorded to salaries expense. And so for next month, the current month on Friday, now those financial statements are showing just 1 day worth of salaries expense. But we still paid our employees for the full week on Friday. Make sense so far? Okay, so we have, that would be a compound entry, 2 debits. The debits added together equal the 1 credit to cash, and so we know that we're okay with that. There's one other way that companies may choose to make this entry. I'm going to go back like this. So, whoops, let me do that. So, some companies have a policy of automatically reversing their adjusting entries, or some of their adjusting entries. And we talked about in the last chapter, when we talked about fixing errors on the trial balance or fixing errors, I talked about the 2 different ways, the 1-step and the 2-step approach to fixing errors. And the 2-step approach, I said the first step is just to reverse the entry that was wrong. And what I meant by that is just do the opposite. So our adjusting entry here, I'm going to change my color so you can see the difference. Our adjusting entry in part B was a debit to salaries expense, a credit to salaries payable. I already erased the debit to salaries expense because that's a temporary account. It gets zeroed out at the end of the month. And so this is the same starting point. We start the next month. If our company had a policy that we would just reverse that adjusting entry, this is what it would look like. We would credit salaries expense and debit salaries payable for that same amount. Now, it looks funny from an accounting standpoint, looks funny at this point because our expense account temporarily has a credit balance. Well, expense account should have a debit balance. Why does that have a credit balance? Well, that allows us on Friday when we pay our employees to just treat it like any other payday. We don't have to worry about how much did we put in that payable, because right now the payable account isn't showing anything. And if we record the payment of our employees the same way we record a regular pay period, not at the end of the period, it would look like this. A debit to salaries expense for the full amount that we're paying and a credit to cash. The credit to cash looks exactly the same. It's the debit to salaries expense that looks different than what I showed you the first time. The end result is the same. The balance in this T account after we reversed the adjusting entry and then paid our employees on Friday, the end result is exactly the same. Our balance would be $5,100 in the salaries expense, and we used $25,500 of our cash, and the salaries payable is at 0. So as I said, I wanted to just show you a little bit past what this exercise asks of us so that you understand how what happens next. What are the next steps for a company after we do this adjusting entry? We still pay the full salaries on Friday. Once we pay those full salaries, whether we choose to reverse the entry or not, as of Friday, when we pay our employees, the net change on our financial statements would be exactly the same. We're showing salaries expense just for Friday, no payable left because we paid our workers what we owed them, and our cash has been reduced by the amount of the payment. So again, a little bit beyond what the exercise required us to do, but I think it's important that you understand, what happens next. Any questions before we move on to our next example? This makes sense? All right, let's move on then to exercise 8. No, sorry, exercise 7. I don't know why I said 8. Exercise 7 is about supplies, and we've actually already talked about supplies a couple different times. So I won't need to spend as much time talking about this as I did the last exercise. We know then, I'm just going to put a couple T accounts here on the screen for us to use. Apologize, my T's aren't terribly straight. So I'm going to put a couple accounts here on the screen. Supplies. That's the balance sheet account. It's an asset. It has a normal debit balance. Supplies expense. It's an expense account on the income statement, normal debit balance. And here I'm going to give an option here, cash or accounts payable. Doesn't matter which one we choose. We could use one or the other. Depends on how we pay for our supplies. It won't affect what we're talking about here. This exercise says the balance in the supplies account before adjustment at the end of the year is $9,000. How did that $9,000 get in there? Well, we bought some supplies. And so I'm going to show you what that entry would look like. My first entry is going to be purchasing supplies. And this is the part that we have seen in an earlier chapter, in an earlier exercise. When we buy the supplies, most companies choose to simply add the supplies to their supplies account, the balance sheet, the asset account, supplies. And then the credit side would be to cash or accounts payable. Again, for us, for this example, it doesn't matter. If this is a real transaction, we'd have to know, did we pay cash for it or did we charge it and we'll pay when they send us the bill? But for this exercise, it doesn't matter. So that's how the $9,000 in supplies got into that account. Well, at the end of the period, we print that unadjusted trial balance that we talked about. And we say, what's on here that shouldn't be? What isn't on here that should be? And this is one of the accounts that we're always going to review. It says we have $9,000 in supplies. Do we really have $9,000 in supplies? we look at the income statement accounts and we see that supplies expense right now has nothing in it, has a zero balance. Is that realistic that we use no supplies this entire accounting period? Probably not. So in the example I've given you before, when we talked about supplies is, you know, when I need a new pen or a new dry erase marker or a new pad of Post-its or some staples or paper clips or paper for the printer, I don't have to write that down. I don't tell anybody. I just go get what I need and I use it. And the reason I don't have to tell someone, except, you know, the polite thing to do is if I take the last one to tell our admin, who is very helpful with that. Other than that, I don't have to write it down. We don't do an accounting entry for every single pad of Post-it notes that someone uses. We aren't keeping track of it. And the reason we're not keeping track of it on a daily basis like that is because it's not material. The cost of this one pen, when we buy them by the case from W.B. Mason, is very minimal cents, right? It would take more expense, more cost to make someone in our accounting department make a journal entry for me to use a pen. You know, it's not worth it. It's not material. It's not going to change anyone's decision making about JCC. And so we haven't been keeping track of how many supplies we've used during this accounting period. And we get to the end of the year, or the end of the period, and we look, end of the year it says, and we look at it and say, we don't have $9,000 in supplies. The exercise tells us that the, whoops, sorry. I need to do that. The exercise tells us the amount of supplies on hand at the end of the year is $1,575. How do we know that? Because we haven't been keeping track. How do we know how much we have? What do you think? How do we know? How does this company know that this $1,575 is the amount of supplies they have? Because our balance sheet right now shows we have $9,000 worth. How do they know it's actually this number?
You take an inventory.
Thank you, Michaela. They take an inventory. I am not suggesting that on a monthly basis, someone goes around at JCC and counts how many Post-it notepads are out there. They're certainly not coming in my office and seeing, well, how many does she have in her desk, you know, on reserve, whatever. But certainly on at least an annual basis, somebody is counting some version of the supplies that are still available. And that might mean going to every supply closet on all 3 locations for JCC. It might actually mean just looking at the main distribution point, the main supply center in Jamestown, and saying how much is here, and anything that's not here still in the warehouse or whatever, we're going to assume that's been used. Again, nobody's asking me how many pads of Post-it notes do you have that you haven't used yet. I worked here for 19 years total, and nobody's ever asked me about how many whiteboard markers I have. So at least at some level, they're taking an inventory and assigning a value to it. In an upcoming chapter, chapter 6, which we'll get to in a few weeks here, we will talk more about that. How do we assign a value to it? How do we know it's $1,575? For now, it's enough to recognize that, yeah, somebody had to go count it and figure out how much is the stuff we still have, how much is it worth. For our purposes for this exercise then, this is what the information is that we're being told. Right now, our balance sheet shows that we have $9,000 in supplies. We actually have $1,575. In other words, the balance in that account should be $1,575. So 2 questions. What do we need to do here, where I just put the arrow, to make that account be $1,575 as we know it should be? And if we're going to credit that account, then we need to debit something else, and I'm suggesting that we're going to debit supplies expense. Why? Because we've used those supplies. We had them, we don't have them anymore. And so we need to debit the supplies expense account so that our income statement accurately reflects the cost of the supplies that were used during this year. So how much, anyone can feel free to answer this question. How much do we need to credit to the supplies account to bring the balance from the $9,000 that's currently in there down to the $1,575 that we know should be in there? $7,425 would bring that balance down to where it should be. And then we're going to debit that exact same amount to the supplies expense. That is the entry we need to put here. Whoops. Sorry. That is the entry we need to put here. A debit to supplies expense and a credit to the supplies. Whoops, wrong number. And so I want to point out to you, we did not have to put the 9,000 in there. That 9,000 going into the supplies account was based on the transaction when we purchased those supplies. We don't have to put the balance in here because when we credit that account, the balance is automatically going to be updated to reflect that we use those supplies. So the journal entry that you're making needs to be for the change you need to make or want to make to that account. The journal entry, the adjusting entry, is for the change that you need to make. Not the beginning balance, not the ending balance, but the amount you need to change in that account. One other comment about that, and then we can move on. Michaela suggested, and I agreed, that someone took an inventory of the supplies. But I kind of outlined for you how problematic that might be. And I'm fairly sure that if I were to ask the business office or the accounting staff here at JCC, how often do you take an inventory of supplies? They're not going to tell me they do it on a monthly basis. Now, someone might be looking at the supplies we have in order to place an order. Are we running low on paper? Do we need to order that? But from an accounting standpoint, I am positive that they're not counting it to make an adjusting journal entry like we did here. And that's probably true for the majority of companies. It's just not a good use of our time because supplies is such a small account compared to all of the other stuff. If this company's using $7,000 in supplies, imagine how much they're paying for salaries and for the merchandise that they're selling and whatever of, the buildings and all the other stuff they're paying for. Supplies is always going to be a relatively small amount. It's not going to be a material amount on a monthly basis. And so, although I would suggest and recommend that there's a physical inventory where someone actually counts the stuff, it probably doesn't happen monthly. It might happen every year. But to make these entries in the interim, it's probably fine just to estimate because these are such small amounts compared to the other information included on those financial statements. So it's okay to estimate. And I think you've probably gotten that idea already. We've talked about estimating when we talked about wages. Well, for most companies, wages are their single largest expense. The salaries and wages they pay to their employees, are their single largest expense. So if it's okay to estimate that huge expense, it's certainly okay to estimate their supplies account. And I'll go ahead and put my green check marks in there. Does anyone have any questions about how we account for our supplies? And this is how most companies choose to do it. Put them on the balance sheet when you buy them, At the end of the period, make an adjusting entry to take into account the part that you have used up. Let's go to our next exercise, which is prepaid insurance. And we have talked about prepaid insurance already as one of those prepaid expenses. Because the insurance is going to benefit us from more than one period, I don't want to do that in red. Because the insurance is going to benefit us from more than one period, at the time we pay for the insurance, if we're not paying month to month, we would record it as an asset on the balance sheet and then gradually move it off the balance sheet and onto the income statement as an adjusting entry. So again, I want to remind you of how this would work. I'm going to start at one step before what's given in the exercise. Remember, we talked last class that these adjusting entries kind of happen with pairs of accounts that clearly have some relationship to each other. And I think that's very, very clear with the concept of prepaid insurance and insurance expense, or prepaid rent and rent expense. Clearly, there's a relationship between those two accounts. Prepaid insurance, the asset on the balance sheet; insurance expense, the expense on the income statement. Okay. This exercise says the balance in the prepaid insurance account before adjustment at the end of the year is $27,000. They said, I want to start one step before that. How did it get to be $27,000? And the way that would happen is because we paid in advance for our insurance. And that entry would look like this: debit to prepaid insurance, credit to cash. We don't immediately debit the insurance expense because this insurance policy isn't just for this month or this accounting period. It's going to benefit us over multiple accounting periods. And so the matching principle that we talked about last class, and I said that's so important. That's the reason we do much of what we do. The matching principle says you need to put the expense in the month that it helped your company, that it matched against those revenues. So if this insurance policy is for 6 months, we should be dividing that insurance over 6 months. 1/6 of it recorded as expense each month. If it's a year, we're going to divide it over a year. Chances are this $27,000 balance, chances are that has multiple insurance policies. We might have a liability policy, we might have a casualty policy, some kind of a property insurance, we might have insurance on our employees. Could be any number of different policies that we have chosen to record all in that same account, and that's fine. So this is where we are at the end of the accounting period. We have $27,000 showing in the asset prepaid insurance. And we look at that and say, do we really still have $27,000 worth of insurance that hasn't lapsed, that hasn't been for prior periods? How much of that was for this year, for this period? And letter A says, the amount of insurance expired during the year is $20,250. Well, when they give you the information like that, and again, be very careful that you read, what are they actually telling us here? That's the part we don't have anymore. It's expired, it's lapsed. So it might be that we have a 6-month policy and 5 of the 6 months have passed. So we should have reported or need to report 5/6 of that cost and keep 1 month still on our balance sheet because that's for next month. If $20,250 worth of this insurance has already lapsed, the time period that it covered, that it protected us, has already passed, that is the amount that we need to move out of the insurance account on the balance sheet and into insurance expense. because it benefited us in the period that has already passed, the period that we're reporting on now. And so what I just put there in green is the adjusting entry we would need to make. And that's going to be the answer for part A. Credit, whoops. Credit to, I think the one that said, a credit to prepaid insurance. I suspect if we had clicked prepaid expense, it would have marked it as wrong. It's just as right, really. Prepaid insurance is more specific. But a company could decide to do its insurance lumped together with some other prepaid expense. So again, the adjusting entry is the change we need to make to that account. We didn't have to put the 27,000 in. We don't need to know what the ending balance is to do that entry. What would the ending balance be though? On our balance sheet, we would still have how much insurance left? The ending balance would be $6,750. That's how much insurance we still have left that's going to benefit us in a future period. And by benefit us, I don't mean we might have a claim against it. The insurance expense still needs to be reported, even if we never had a claim against the insurance. The insurance is benefiting us, it's helping us make money, it's protecting our company. And so as it expires or lapses, it becomes an expense. It helped us with running our business. For part B then, oh shoot, didn't mean to undo all of that. For part B then, let me go put this back in, prepaid insurance. Oops. Didn't mean to erase all those parts. So the prepaid insurance had a balance of 27,000. Okay. For part B, we're going to start from here. And instead of telling us how much had lapsed in part B, it tells us how much we have left. Again, you have to be very careful to recognize what's being told to us. The amount of unexpired insurance for future periods, so that's the part that should still be an asset for us, is $6,750. So in part B, they're telling us how much we have left. Our job is to calculate how much we need to remove from the prepaid insurance and record on the income statement as insurance expense. So how much would that be? What's the adjusting entry we need to make?
Wouldn't it be the same as the one above?
Yeah, and you know, sometimes the people who write these exercises irritate me a bit, because that's not very helpful that it's the same number. But it is what it is. Yes, it is the same number. But the reason it's the same number is because they just weren't very imaginative, apparently, when they wrote this exercise. I would have had to be a whole different number. So it would be the same, but the way we calculated that is by taking the amount that's in there right now, 27,000, and subtracting the ending balance that we're told should be in there, just like we did with the supplies account. The ending balance should be 6750. So how much do we need to remove from that account? 20,250. And I'd like to call it just pure coincidence that it's the same number. But again, I'm going to write it up off as a lack of imagination. I should give them more credit. Maybe they have some reason that they made it be the same. I wouldn't have done that. Any questions about prepaid insurance? You understand why we do the adjustment, how we do the adjustment, why it's necessary. Pay attention to how the information is given to you, because it really could be either way. If I were working for this company, I would do whichever, because I'm me, I like to be efficient. I would do whichever is easier. I would either look at the policies that had lapsed or look at what we had left, and whichever was the easier to calculate, that's the number I would come up with and do the entry from there. It's not about being lazy, it's about being efficient. If there aren't any questions, we're going to keep going. Exercise 9, and I mentioned this on Monday. This is going to take me a little bit longer to explain because it's red. Because I think it's important that you understand not just how to do the journal entry, because honestly, we could go through this exercise in 30 seconds and you'd know the answer and you'd know how to do this journal entry, but you would have no understanding of why or what's actually happening. And so I'm going to put actually 4 different T accounts here on the screen and walk you through the scenario so that you have a better understanding of not just how to do the entry, but why it works this way. So this is for equipment. So I'm going to have an equipment account. On Monday, we saw an account. I'm going to try to write this whole thing out. Accumulated, it's not going to fit neatly on top of my close as I can get to centered. Accumulated depreciation for that equipment. We saw that account on Monday, excuse me, on Monday when we did exercise 5, where we had the trial balance and we saw the changes, then we had to journalize what it looked like. And I told you on Monday we'd talk more about it today. And cash. And one more account here, depreciation, whoops. Depreciation expense on the equipment. Okay. So there's our 4 accounts that I'm going to need to talk about this exercise. I don't want to confuse anybody. I am going to just make up numbers. I'm totally making up these numbers. Okay, they're not in the exercise. They're not true numbers, meaning there's not some way that I magically know these numbers. I'm just totally making them up so that you understand how this works. Let's pretend then that we buy some equipment. And I'm just making up the amount. I'm going to say that we bought $100,000 worth of equipment. So when we buy that equipment, it would look like this. A debit to equipment and a credit. We must have a lot of money sitting around. We didn't borrow the money or anything. We paid cash for that equipment. Of course, the credit side of that could be to some liability, some payable. Maybe it's a loan payable or a mortgage payable or whatever. I'm just calling it cash. Fine. That's what we call a balance sheet transaction. What happened here? The asset equipment went up and the asset cash went down by the same amount. So in total, our assets are still the same. We've exchanged one liquid asset, cash, for a less liquid asset, a long-term asset of equipment. We could buy equipment all day long if we had the money or the credit to do so. Buying equipment doesn't help us make money as a business. Buying equipment has not helped us at all in running our business. It's important because now we have the equipment and we can use it, but buying the equipment itself is not an expense because our definition from chapter 1, our definition of an expense is something that helps us to make money, helps us to generate revenues, right? We could buy this equipment and put it in the back room and never even take the plastic wrap off it, not helping us make any money. Does everyone see that? So that's why there's no income statement effect just from buying the equipment. Now we hope then that we're going to start using the equipment to help us make some money. So I'm just making this up. When at the time we buy the equipment, we need to have some kind of an estimate of how long we're going to use that equipment. And we call that the estimated useful life. So we know we paid $100,000 for the equipment. We have an invoice, we have a check, we know how much it costs, but we don't know exactly how long we're going to use it. We have to estimate. And I'm estimating 10 years. Totally making this up, okay? It's not in the exercise anywhere. I'm just putting numbers on it so you can see what's happening. At the time we acquire that equipment, we have to estimate how long do we think we're going to use it. We also have to estimate how much we think it's going to be worth when we're done using it. I ran out of room there. We have to estimate how much it's going to be worth when we're done. So at the end of the 10 years, we know the equipment cost $100,000 up front. At the end of the 10 years, how much do we think it's going to be worth? It's an estimate. There's no guarantee. It could be worth more or less than that. I like the term residual value, but you'll sometimes see other terms for that. Salvage value, scrap value, trade-in value. Maybe in 10 years, we're planning to take this equipment, sell it or trade it in and get some new equipment. Okay, so all those terms really, from an accounting standpoint, mean the same thing. Residual, salvage, scrap, trade-in. The concept is how much is it going to be worth 10 years from now when we're done using it? Again, I'm making up this number, $18,000. Totally made it up. Don't know that. The company doesn't know that. They don't know for sure they're going to use it for 10 years. They don't know for sure it's going to be worth $18,000. But they have to estimate those. We cannot do this without having an estimate of those two things. So how much of this value are they going to use up? How much of the $100,000 that they paid for this do they expect to use up over the 10 years that they're using it? Well, they paid $100,000 for it, but they think it's going to keep $18,000 of its value. They are, this over a little bit more. They are going to use up $82,000 worth of the cost of that equipment. We call that the depreciable cost. And you'll notice that that term depreciable has the same root as depreciation, right? The depreciable cost is the upfront cost minus the part that we think it's going to retain, the $18,000 salvage value or residual value. It's the $82,000 represents the amount we are going to use up. And if you think about the matching principle, that's going to be the part of the cost of this equipment that we need to record as expense, because that's the part we're going to use up running using the equipment in our business. So $82,000 represents the amount we need to record as expense for our business. But do we want to record it the very first month that we're using the equipment? No, because we're going to be using it for 10 years, we think. And so the $82,000 needs to be, I'm going to underline that, the $82,000 is the total expense we want to record over the whole life of the asset, over 10 years. And so the simplest way to do that is something called straight line depreciation. Simplest way of recording this. We know we're going to use up $82,000 worth of the value of that asset over 10 years. So that would be $8,200 per year. And yes, it's not a coincidence that that's exactly what it tells us in the exercise. I was just trying to show you, using the number that's given in the exercise right here, okay, where that number may have come from. If you look ahead on our syllabus, we are going to be in several weeks, we are going to be looking at Chapter 9 on long-term assets. In Chapter 9, we will come back to this. You'll hear me use these same terms and go through the same basic calculation in Chapter 9 for straight line depreciation. But we will add to that in Chapter 9 is 2 other ways of calculating depreciation. So in Chapter 3, you are not responsible for knowing how to calculate depreciation. You can see in this exercise, it tells us exactly what the depreciation is. And so as I said about 7 minutes ago, we could have done this exercise in 1 minute. I could have showed you just how to do the depreciation entry. But I don't find that very useful because you have no idea what it really means. So I've just given you a preview, a heads up from Chapter 9. And when we get to Chapter 9 in about 6 weeks from now, we will come back to this and spend more time on it. But now at least you have a sense of what depreciation means. Depreciation is an accounting technique to take the upfront cost of the asset and spread out the expense over the useful life of that asset. And why do we do this? The same reason we do so many other things. It's the matching principle. The matching principle says you record the revenues when you've earned them, and then we match the expenses for that period against those revenues. Well, if we're going to use this equipment for 10 years, we need to spread the expense over 10 years. Everybody with me so far? Okay. Now we can actually do the entry for the exercise. And then I'll put it in T accounts and talk about it for another second. A depreciation entry always looks like this: a debit to depreciation expense and a credit to accumulated depreciation. I don't know if there was a depreciation expense. There isn't one that has, like I do, have the equipment on the end, and that's okay. The depreciation entry always includes a debit to the expense account that's on the income statement and a credit to accumulated depreciation on the balance sheet. I could have just done that and said, okay, we're good. Some of you might be thinking, okay, yeah, you should have done that. I don't think that's very helpful. It doesn't explain the why part. That's the bookkeeping part, not the accounting part. So I want to put these into the T accounts so we can see what this looks like. Debit to the expense, that's the income statement account. It has a normal debit balance. Recording the entry increases our expense, decreases our income, decreases our equity. But this accumulated depreciation account, we need to talk about that for a minute. Because I said that's a balance sheet account, but we can see maybe here that it has a normal credit balance. That's kind of weird. Because it goes with the equipment. The equipment is an asset and it has a normal debit balance. Accumulated depreciation, I'm just going to put some terminology here on the screen. Accumulated depreciation is an account type that we have not yet seen. It is called a contra asset. Contra means against. To be contradict someone, you speak against them, right? You say the opposite of what they said. If you're contrary, it means that you go against people, right? A contra account, and this isn't the only contra account we will see this semester. A contra asset account goes against the asset. So it has a normal credit balance. So I could put the minus sign over here and the plus sign over here. It goes against the asset. It has a normal credit balance. But it's listed right along with the assets. So on our trial balance, on our chart of accounts, if the equipment account, just making things up here, the equipment account is an asset account. So using what we've talked about before, it would likely start with a number 1 because it's an asset. But because it's a more long-term asset, it's not liquid, it's not real liquid. We're going to have this around for 10 years, we think. It's going to be a higher number to account. So I don't know, maybe it's account 171, just throwing a number out there. This accumulated depreciation account then would need to go right along with it. And so it might be account number 171A or 172, depending on how we number our system. But those two accounts go together. We can't separate them. We have to look at them together. Because we've got the asset, equipment, and the contra asset that goes with it, goes actually against it. This is what we would see on our balance sheet. We would see the equipment. We would see the original or historical cost for that equipment, $100,000. Very next line, we would see, and I'm going to just abbreviate for space purposes, we would see the accumulated depreciation. I wrote less accumulated depreciation because we need to subtract it. It has a credit balance. It reduces, goes against the value, the original cost of that equipment. And don't have enough room here, unfortunately. Okay. Let me put some lines in here. And so this is what we would see on our financial statements. We can see the original or historical cost. That's how much we paid for it. Then we can see how much of that value has been used up or turned into cash. In this case, used up, recorded as expense. And then we can see what's left. The book or the carrying value is what's left. And that $91,800 book value is what would be included in our total assets. Now, with what we've already discussed, we know depreciation expense is a temporary or nominal account, and at the end of the year, that would get zeroed out. The contra asset, accumulated depreciation, is a permanent account. And so the $8,200 that we put in there the first year that we used it would stay in there. And then year 2, we would report another $8,200. And so now it has $16,400, and the book value of the asset would be down to $83,600. And each year we record $8,200 in expense, and we add to that accumulated depreciation. That's why it's called accumulated. It keeps adding up. right? So each year we add another 8,200. And at the end of 10 years, assuming nothing changes, at the end of 10 years, we have put $8,200 into that account every year. So at the end of 10 years, the balance in that account would be, whoops, the balance in that account would be 82,000. 10 years at 8,200. And at the end of 10 years, the book value or carrying value for that equipment would be $18,000. And where have we seen that before? Right here. When we bought that equipment, we had to estimate how much is it going to be worth. It is not a coincidence that if we use this asset for 10 years and record the depreciation every year with no changes, at the end of the 10 years, our books, our records, our balance sheet shows that equipment worth exactly what we said it would be worth. Because that's how we did the math. In chapter 9, we'll spend more time on this and we'll see, okay, but is it really worth 18,000? And the answer is almost certainly no. It could be worth more than that. It could be worth less than that. It may have no value at all. We might have to just throw it away. Or in an even worst case scenario, we might have to pay someone to take it from us. Or we sell it for scrap or something like that. Okay. So at this point, again, you don't have to worry about where the 8,200 comes from or how that's calculated, but at least you have a sense of what we're doing with depreciation. The entry will always be a debit to the expense, a credit to the accumulated depreciation. The book value is calculated by subtracting all of the depreciation we recorded from what we paid for it. But that book or carrying value may or may not be close to the actual market value. And that's not what we're trying to do here. We are not trying to carry this asset at fair market value on our balance sheet. Depreciation, one more time, is an accounting technique that we use to take the upfront cost of that equipment and record it as expense over the estimated useful life. Our estimates are not going to be perfect. We do the best we can. And in chapter 9, we'll learn what do we do then when we're done using the asset. We'll also talk about in that chapter, what do we do if things change? So in my example, we thought we'd use it for 10 years and we thought it would be worth 18,000 at the end of that time. We might decide to use it for 12 years or 8 years or 4 years or 2 years. We might use it for exactly 10 years, but it's not worth 18,000 at the end. It could be worth more or less, nothing. Any questions on that? General concept. And for this chapter, all you need to be able to do is this entry. But I think it's much easier if you understand why and what we're actually trying to accomplish there. If there aren't any questions on that, we're going to go to our final exercise for this chapter. Everybody's good? And so we've already talked about this concept. I just talked about it in the last exercise. The balance in the equipment account is $3,150,000. That represents the historical cost. That is the amount we paid for all of our equipment when we acquired it, which may have just been one purchase. It may have been 20 purchases spread out over 15 years. I have no idea. The equipment account shows the original or historical cost. The accumulated depreciation, the contra asset account, is how much we have used up or recorded as an expense over the time we've been using the various equipment. So with what we just discussed in exercise 9, you should be able to calculate the book value. It's the original or historical cost minus the accumulated depreciation. 3,150,000 minus 2,075,000 is 1,075,000. That's the book or the carrying value of that equipment. That's what's included in our total assets on our balance sheet. And we've already addressed part B as well. Does the balance in the accumulated depreciation account mean that the equipment's loss of value is 2,075,000? And people in the classroom are shaking their head. No. Could it be? Could be. Could be. Probably not though. Because remember, it's based on two estimates. How long are we going to use it? How much is it going to be worth when we're done? And I already mentioned in chapter 9, we're going to learn one straight line plus 2 more ways of calculating depreciation. In each one of the 3 methods, then, you would have different calculations for the depreciation expense. In total, over the life of the asset, it will be the same. But how we divvy it up across, again, back to my example, in 10 years, we knew we had to report $82,000 in depreciation. Straight line is the easiest. We just report the same every year. The other 2 methods report different amounts each year. The total over the 10 years would still be 82,000, but it's how we divide it up over the useful life. So depreciation is an allocation of the upfront cost of the equipment to the periods benefiting from its use. It is not, as I already said, it is not an attempt to make the book value on our balance sheet be equal to the fair market value of that asset. It is just the accounting technique to take the cost and allocate it or divide it up over its useful life. And with that, we are done with our chapter 3 exercises. Before I stop this video, does anyone have any questions or comments? Let me stop the video. Don't go anywhere.